Welcome to AM Best Audio.
Allocations to infrastructure debt in recent years, drawn by its combination of long-duration cash flows, contractual structures, and diversification benefits relative to traditional fixed income. I'm John Weber for Best Review Magazine. I'm speaking today with Orhan Sarayli, head of Barings North America Infrastructure Group, to explore how infrastructure debt is being used within insurer asset allocation strategies. Orhan, so glad you could join us today.
Thank you very much, John. It's a pleasure to be here.
So, Orhan, how does infrastructure debt fit into an insurer's asset allocation?
Well, we'd like to think it fits very nicely with an insurer's asset allocation. There are a lot of benefits that we think infrastructure debt brings to insurance asset allocation strategy. Obviously, for the first and foremost, it's a very well-performing asset class from a loss perspective. So in terms of protective capital and using the best risk-return attributes, we think infrastructure debt brings a lot to an insurer's portfolio. We also believe that it provides diversification benefits to an insurer's asset allocation strategy. And also, these tend to be long-lived assets. So from a duration perspective, it probably is accretive in terms of expanding the duration profile of a portfolio.
Is this intended as a long-term core allocation or an opportunistic sleeve?
Well, John, we think it could be both, depending on how the insurer wants to participate in the investing strategies. Infrastructure debt has matured and expanded in its offerings, so we believe an insurer can participate in multiple ways to get whatever objectives they want. It absolutely serves as a strong tenant, we think, for a long-term fit within a portfolio. But with increasing high yield strategies and or opportunistic type approaches, including CLOs, for example, there are numerous ways for insurer to play. So we think it could be both a core component of a long-term portfolio strategy, as well as opportunistic plays to fit whatever the insurer's asset allocation needs may be at that time.
Orhan, how resilient are assets through economic cycles?
We think, John, it's one of the major benefits of infrastructure. In the time period that we have managed our portfolio here, the infrastructure asset class coming off the global financial crisis, weathering through the pandemic, and of course various cycles in between amongst all of them, the portfolio is held very strong. And there have been numerous studies out there, publicly available, that also show how infrastructure has performed generally better than other asset classes in terms of default rates and loss statistics. So we believe, again, the defensive nature and essentiality of the assets contributes to its very strong loss performance and therefore really makes it an ideal fit to have as part of your portfolio.
Are returns driven more by liquidity or structural complexity?
Well, I think it's a little bit of both, and I actually think it's more than that. Certainly, it is a less liquid asset class than many others that insurers have the opportunity to participate in. It is generally more of a private asset class, so you do get that illiquidity premium, and we strive to get that illiquidity premium out of all the borrowers that we can. So we do look for that illiquidity premium. There can be and usually are structural premiums because these are generally very highly contracted assets in nature. So you are looking at the ability for the contracts to withstand challenges. And of course, there are other derivative aspects to it in terms of operational performance. Perhaps there may be labor situations you need to manage around. So there are a lot of structural complexities that you need to get comfortable with. But overall, we believe the juice is worth the squeeze. And as a result, what you're going to get out of it, we like to think, if you will, a comparably rated infrastructure asset will perform at a higher rating level than a corporate asset may perform at from a rating perspective. And thus, if you're getting similar pricing, we think you're actually getting a premium for that aspect alone, but we think you get a little bit more for everything else you mentioned.
So, Orhan, what document protections do you look for to mitigate risk?
Well, I think it's similar to what you may see frankly, in a lot of other asset classes. Like, the key thing for us is we want to make sure that we have as much control over the borrower as possible. So there are usually a lot of covenants that we require, and in essence, because the underlying asset is essential, anything and everything you can do to control the borrower's ability to change the asset's performance is critical. So usually these assets have a singular purpose. Maintaining that singular purpose is paramount. And making sure that the borrower cannot do much in terms of the capital structure beyond the way it's been initially defined. So if they grow, great, we'll allow them to get additional debt, but we very tightly cap exactly how much debt or how much CapEx can go into the asset and really strive to keep the asset as static as possible.
Orhan, thank you so much for taking the time to speak with us today.
Great, thank you very much, John.
That was Orhan Sarayli, head of Barings North America Infrastructure Group. And I'm John Weber for Best Review Magazine.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.